Yeah. Good evening, everyone.
Recording in progress.
Good evening, everyone. Welcome to the session on indirect taxes, CA final. The topic what we are going to cover is in today's session is your input tax credit. We had started off the session with the concept of supply, the charge of GST. We also covered the exemptions, and then the other faculty must have taken the concepts regarding the place of supply and time of supply. So the most important topic in GST is your input tax credit, which is forms the fundamental aspect in the law, in the indirect tax law. The concept of input tax credit is important because this was the main reason why the GST law came into the force. Due to multiple legislations being there in the past, that is prior to 2017, there used to be multiple taxes. Like there used to be excise duty on manufacture, there used to be service tax on provision of service, there used to be VAT on the sale of goods. The input taxes of VAT, service tax, etc., which was being used for paying the respective output VAT, output service tax, etc., was available only with respect to the set taxes and not to everything. What does that mean? That means, let us take an example here. A person is in the business of selling ready-made garments. He is purchasing the garments. This was before 2017 example. He had a shop. He used to purchase the garments and he used to sell the garments to the customer. He used to pay rent for the shop. He used to spend on advertisement. He used to spend on other professional services, and multiple other expenses used to be incurred by him. But when it came to the VAT chargeability, he used to charge the VAT on the sale of the garments, and whatever amount he paid on the purchase of fabric and the purchase of garments, VAT again can be was allowed paid, because at that point of time service tax was applicable on all these expenses. That service tax input was not available to the taxpayer. So because of which, what happened? The cost, this service tax on the rent, the service tax on the advertisement increased the fixed cost of the dealer, of the taxpayer. But whereas in GST, since now there is no concept of service tax, there is no concept of VAT, everything is under one single umbrella called GST. Input tax credit of everything will be available. Therefore, in today's situation, if you are into the same business of ready-made garments, you can take the GST credit of rent, GST credit of advertisement, and also the GST credit of the amount whatever you have paid for the purchase of your fabrics and the garments, right? So this was why the input tax credit is very, very important. So therefore, in the previous indirect tax regime, there were a lot of deficiencies in the system. Multiplicity of taxes added to the confusion. And due to this, the businessman could not make the actual profit what he had to make because of the multiplicity of taxes as well as the lack of input tax credit which was available. One more important thing is the state against central tax set-off was not available. As I told you, the VAT input was not available for paying the output service tax. The service tax input was not available to pay the VAT. Yeah, just give me one moment. Some issue with my network here. Yeah, sorry. So therefore, that set-off was not available with regard to the central and state. And therefore, the GST promises seamless input tax credit. That means input tax credit was easily available with regard to input GST and output GST, right? So that was also important point which you have to know. Also, the scheme is designed to avoid cascading effect of taxes and make GST a destination-based tax. As I told you in the very first session, cascading effect. Cascade means waterfall. Just like the in the water in a waterfall keeps adding at each step. The taxes keeps adding at each step. That is why the term cascading effect. So therefore, main input tax scheme, the objective is to avoid the cascading effect of taxes and make GST a destination-based tax. Broadly, ITC is available on all inputs, all input services, and capital goods for purposes of business of a taxable person. That is simple. All the inputs are available subject to certain restrictions, which we will discuss during the today's session. So therefore, input services and capital goods used for the purposes of the business, ITC is totally available, right? But only exception here is blocked credit, which we will discuss in section 17 in our coming discussions. Again, the GST law does not require one-to-one correlation between inputs and final products. That means it is not like I purchased this product and I'm selling this product. So therefore, only on this product I can claim the input tax credit. I cannot claim the credit on all the any expenses. So one-to-one correlation is not required. Generic manner, in a general manner, you have to see whether the expenses is relating to your business. So this generic view of the expenses relating to the business has to be taken into consideration, and accordingly, the input should be claimed. So therefore, one-to-one correlation is not required. That itself is a huge relief. Otherwise, if this product is there, it correlates to this only, then you can claim as a credit. If such rules were there, it would have again become very complicated, right? So let me see if there are any queries from last sessions. Also, if there are any queries, please feel free to ask the same. 1 second. Good evening, Rashmi, and good evening, Jyoti. Yeah, okay, nothing as of now. So let's continue. So therefore, important point. Input tax credit can be availed only for payment of tax on output taxable supply. That means if you are making the payment of tax, fine. If you are making the payment of tax on your output supply, only then you can claim the input tax credit of the taxes what you are paying on your input services and capital. So that means what? In case you are in the business of exempt products or services, let us take an example of hospital. We discussed in exemptions chapter also. Hospital healthcare services are totally exempt as per the GST rules. As per the notification, it is very clearly exempt. So therefore, the expenses which are undertaken by the hospital in the provision of the healthcare services on which the hospital pays the GST, will we get the input tax credit? The answer is no. You will not get the input tax credit of the same. Fine. You will not get the input tax credit of the same. Fine. So that is again an important thing which you have to remember. So therefore, if you are in the business of providing an exempt supply of exempt goods or services, you will not claim the input tax credit. Input tax credit will be available only in case you are in the business of providing taxable output supply. The understanding of the term zero rated supply is very, very important, because input tax credit can be claimed in case you are into making a zero rated supply. So what is a zero rated supply? Very, very simple terms. Zero rated supply is basically your export of goods or services or supplies to a special economic zone. What is a special economic zone? It is a zone which is situated in India, but for all taxation purposes, it is considered as a foreign country. So therefore, zero rated supply means what? Exports or supplies to special economic zone is zero rated. That is, on these transactions, GST is not applicable. On these transactions, GST is not applicable. However, input tax credit can be claimed. Sir, your next query will be, sir, if input tax credit can be claimed, if there is no tax on the output supply, how will they adjust the input tax against the tax? Because there is no tax on outward supply. The answer is the input tax credit can be claimed as a refund. You can apply for the refund to the GST department and you can claim back this amount as a refund. Okay, I hope you have got this point and there is no query here. So therefore, in this particular situation, zero rated supply. Why is this? You may ask this question. So if there is no GST, input tax credit also is granted as a refund, isn't there a revenue loss to the government, sir? Maybe your question. Even though there is a revenue loss, the advantage is the moment foreign currency comes into the country, automatically the strength of the Indian currency increases. That is precisely why it is an incentive which is given purely to exporters, that you start the business of export, you start the business of uh, getting foreign currency through your business, we will give you incentives by way of refund of input tax credit. That, in simple terms, is the benefit which is given. Section 16 to section 21 and rules 36 to 45 prescribe the provisions relating to input tax credit. As always, the state GST law also prescribes identical provisions with regard to input tax credit. Now, why this is important? Now, there is a situation here where input tax credit, though it is available for each and everything, you cannot have an ideal situation where you'll be able to easily track as to how much input tax credit is available for the taxable supply. Because there may be a situation where you're having both a taxable and exempt supply. There may be a situation where your expenses are being used for both business purposes and non-business purposes. Then how do you do the ITC? These complications are also covered in today's session, where we will discuss rule number 42 and rule number 43 of the CGST rules, which clearly speaks about input tax credit in case it is used for both exempt and taxable supplies, and input tax credit where it is used for both business and non-business purposes. So therefore, if a taxable person is making both taxable and exempt supply, that means whichever input services and capital goods are used totally for taxable supply, for that he will get the credit. Which is totally used only for exempt supply, he will not get the input tax credit. Again, let us take an example here. Same hospital example only we will see. Hospital is running a business, running the healthcare services, and also it operates a pharmacy. It operates a pharmacy wherein, along with all the medicines, it also sells your regular deodorants, soft drinks, and energy drinks, and all of that. Some pharmacies do that as well. So therefore, here what happens? That hospital is running the pharmacy. So hospital is procuring a hospital bed for the treatment to the patient. Hospital bed, let us assume it is a capital group. GST is applicable on hospital beds. GST is paid on the hospital beds. Will it get the input tax credit? It directly relates to the exempt supply. It is exclusively related to the exempt supply. So there is no question of input tax credit. Another example, if the pharmacy procures a soft drink like a ORS energy drink and sells it to the customer, Is it related to the taxable supply? ORS energy drinks chargeable to GST. So therefore, whatever you are procuring, that same thing you are selling, directly attributable to taxable supply, you can claim it. I hope this point is clear. There may be a situation, a common input and input services and capital goods are used for taxable as well as exempt supply. In the same example, hospital is there, pharmacy is there, right? You go into the hospital, you are entering the pharmacy, right? There certain furniture is there. That is a part of the hospital also, and it is used for the pharmacy also. That means what? It is a common input tax credit. So therefore, how to determine this? You have to see what is the turnover of exempt and what is the turnover of taxable. In that proportion, you have to attribute that credit. So in this, rule number 42 and 43 will give more clarifications with regard to this. Then also ITC on inputs and capital goods sent for job work. Even when inputs and capital goods are sent directly to the job worker without being first brought to the place of business, then also it is allowed. So job work means what? You have certain products on which certain procedure or process needs to be undertaken. So you send that product to the job worker, he undertakes the procedure, and he sends it back to the principal. The person who sends the goods to the job worker is the principal. Here what it says is, these inputs and capital goods, you can send it directly to the job worker without being brought first to the place of business of the supplier, right? So even if inputs and capital goods are directly sent to the job worker, so that means what? You have some products, you procure some products from a person, you procure it and then you send it to the job worker. Second situation, you ask him to send it directly to the job worker. So the rule says that the ITC is available even if the goods are sent directly from that person's premises to the job worker premises. It need not be brought to the place of business of the supplier. Still, the input tax credit is available. Then input services received at head office or branch office are ultimately used indirectly for supplies made from manufacturing or trading or business premises. ITC can be availed through mechanism of input service distributor. What does this mean? Now, there may be a situation where you have multiple offices. Let us assume there is a chartered accountancy firm. You have offices in Mumbai, Delhi, Hyderabad, Bangalore, Chennai, 5-6 offices are there. You have given a contract of security services, that is to look after the cyber security and the data protection services to a particular software company. This software company takes care of all the 5 to 6 offices within the country. And they say, this is our total bill, sir. In this total bill, 5 to 6 states in which your offices are covered, all these services we provide. Now, what does this mean? Your head office is in, assuming, Delhi. All other offices are there. Does it? And of course, if you are in different states, you have to take different GST registrations. You will understand this in the registration topic, which is going to follow the next class after the input tax credit. So in each state, different registration is there. But is it fair that the input tax credit can be claimed only by Delhi? Is it fair? Definitely not. Because the expenses are being, the services are being used by all the offices within the country. So therefore, you have to distribute the input tax credit. How do you distribute the input tax credit? Input service distributor, ISD. A separate registration needs to be taken. Usually the head office takes the registration. This input service distributor tracks the turnover of each particular state, derives the total input, accordingly distributes this input tax credit to each particular GST registration by filing one particular form in the GST portal. This is the concept of input service distributor. Fine. I hope all these are clear. These are various concepts which we are going to cover in our discussion in the coming few hours. Oh, good evening, Dilip. Good evening, Viraj. Dilip, sir, zero rated supply and exempt supply are same or different? Zero rated supply and exempt supply are totally different. The difference being that ITC cannot be availed with regard to exempt supply, but with regard to zero rated supply, the ITC can be availed, right? Zero rated supply, the ITC can be availed. That is what is the rule. I hope this is clear. Will it not lead to loss to the government? Definitely the loss to the government is there, but the compensation by way of receipt of foreign currency in the country, the exchange rate, because the banks get the foreign remittances. The moment foreign remittances come, the strength of the Indian rupee increases. So always imports are not beneficial for the country, whereas exports are beneficial to the country. That is why they say make in India. So if you manufacture within the country and you export it, that is the best way. That is the best way a country can progress, because that is when a lot of foreign currency creeps into the country. That is why this incentive is given, especially for exporters. Sir, but if you claim refund on zero rated supply, whether it is given to the person claiming it or whether it is deposited to consumer welfare fund, cause incident and impact is passed on to the ultimate customer. It is clearly credited to your bank account, not to any consumer welfare fund. Even though incidents and impact is passed on to the ultimate consumer, that consumer is located outside the country. So therefore, very simple. If you are importing something, you are supposed to pay customs duty. You are supposed to pay IGST on that. So similar way, if you export it, definitely that cost will be added to it. There is no point in giving benefit to a consumer outside the country. If he is wanting to procure something from India, that means we have to make sure that the cost is the highest possible cost for that person. So there is no point in giving any benefit to the customer outside the country. So therefore, definitely in this case, incidence and impact is not passed on, because the costs are built up in the exports. As simple as that. It is better that the cost of the Indian person who exports is reduced. That is why refund is given. Sir, is refund available on GST on purchases for zero rated supply? Yes, definitely it is available. There are some in refunds chapter, you will see clearly the provisions related to that. You have to file a particular form with the GST officer. You have to give the proof of exports by way of shipping bill and export general manifest, EGM. And also IceGate, there is an IceGate portal on which those screenshots of the exports have to be given. FIRCs, foreign inward remittance certificate. That is, if any foreign currency hits the bank account, and a certificate is generated called as FIRC, foreign inward remittance certificate. All these copies have to be furnished to the GST department, through which refund is granted. Does ISD distributes credited to the branch automatically? Yes, it does. It files a return. I don't exactly remember the name of the return. That return is filed, and the respective credit is distributed to all the particular states. Sir, if a person is dealing in exempted supply and paid RCM liability, can he reverse the tax paid on RCM or not, as he is dealing in exempt side? Unfortunately, no, but there is a recent amendment in the budget which has come, wherein this RCM need not be paid in case total exempt supply, but it is not relevant to your examination, because the changes will be applicable only for the month of November. So if you are writing in the month of May, that means in this particular situation, whatever exempt supply is there and RCM is applicable, then 100% he has to pay. Unfortunately, there is no other way out. I hope these queries are clear. Now we come back to our discussion. Glad to see a lot of queries today. Good. It shows that you are following the discussion. Thank you very much. So let's go back to some definitions before we go to the main section 16, 17, and 18. 2 subsection 19 defines capital goods. It means the goods, the value of which is capitalized in the books of account of the person claiming the ITC, and which are used or intended to be used in the course or furtherance of the business. It means what? Capital goods had a very, very elaborate definition in excise duty before 2017. It had a huge definition, wherein certain selected products only were classified under capital goods. This time the government didn't want any of that headache. It totally gave the responsibility of classification of capital goods as to what you're giving as the accounting treatment. So accounting treatment, whatever you're capitalizing in the books of account of the person which is claiming the ITC, which has used or intended to be used in the course or furtherance of the business, the value which is capitalized in the books of accounts, that is goods which are capitalized are treated as the capital goods. 2 subsection 59 defines the term input. It means any goods other than capital goods used or intended to be used by the supplier in the course or furtherance of the business. So other than capital goods, any goods is your inputs. Okay, very simple. Input services, any services used or intended to be used in the course or furtherance of the business. The phrase in the course or furtherance of the business is very, very important. You have to use that particular product in the course or furtherance of the business. Now, I I am running the business of training services. I give coaching services to students. GST is applicable. I bought one treadmill for my house for doing exercise. I say I'm doing exercise to maintain my health. Only then I'll be very healthy to give the training or coaching. This sort of weird logic I make, and I tell I'll claim the input tax credit. Nothing doing, it is not allowed. Is it related to your business? How is it a treadmill related to your training services? If you are into gym training, it's a different issue. You are providing the teaching services and training services. Just because you bought credit for your you bought your treadmill for your house, how does it mean you can claim the credit of that? So therefore, it should be in the course or furtherance of the business. It should be for the particular business. Only then input tax credit can be claimed. Input service distributor, just now we saw an example, means office of supplier where invoices are issued, prescribed document he gives for distributing the credit of taxes. We will see an example based on this also, right? Then definition of input tax credit has this term input tax, which is clearly there. In relation to registered person, what all does it mean? Tax charged on the supply of goods or services includes IGST on import also. If you are importing the goods, IGST is paid. This IGST is not collected by the GST department, it is collected by the customs department. But can you get the credit of this? Definitely you can. So on import of goods, if you are paying any IGST, definitely you can claim. Then tax payable under provisions of 9.3 and 9.4, reverse charge mechanism, charge of GST, we clearly covered these sections. Whatever taxes you're paying under the reverse charge mechanism, claim as the credit. 5.3 and 5.4 of IGST are the same as 9.3 and 9.4 of CGST. So that also can be claimed. Again, tax payable under 9.3, 9.4 of SGST, 7.3, 7.4 of Union Territory. So all these are pretty much the same. So all these are your input taxes, but does not include the tax paid under the composition levy. What does this mean? You are opted for the composition scheme, which we have already covered, section 10. In the composition scheme, you are paying some tax at the rate of 1% or 2% or 5%, depending on the type of goods or services. So in the whatever taxes you are paying under the composition scheme, you don't collect it from the customer, but you pay it from your own side. So therefore, whatever you are paying under the composition levy, you cannot claim it as the input tax credit. That is very, very clear. 263 input tax credit means credit of input tax, very, very clear. And 266 talks about invoice or tax invoice. It means the invoice referred to in section 31. Inward supply, again, what is inward supply? In relation to person shall meet the receipt of goods or services or both, whether by purchase, acquisition, or any other means with or without the consideration. Receipt of goods or services is inward supply, either by purchase, acquisition, or any other means with or without the consideration. Job work means what? Means any treatment or process undertaken by the person on the goods belonging to another registered person, and the expression job worker shall be construed accordingly. Yeah. So here, job work is your any treatment or process undertaken by the person on goods belonging to another registered person, expression job worker shall be construed accordingly. So if you are undertaking any treatment or process, goods are belonging to a registered person, on that you are doing some process. On that, if you do some process, it is a job work, and the term job worker shall be construed accordingly. Very, very simple. That is your 2 subsection 68 job work. 2 subsection 72 manufacture. We already seen this definition. Processing of raw material or inputs in any manner. New product will come having a distinct name, character, and use. So these 3 properties: distinct name has to be there, distinct character has to be there, and use has to be there. And the term manufacturer shall be construed accordingly. Motor vehicle, same meaning as in 228 of the Motor Vehicles Act. There is one definition in that. Motor has to be there, movement. It's very technical definition, not very important. So motor vehicle, why it is important is it is covered in section 17 subsection 5 blocked credits. So we will go there once we go there, we will see this. Then non-resident taxable person means any person who occasionally undertakes transactions involving supply, whether as principal or agent, but has no fixed place of business or residence in India. So non-resident, the main feature is no fixed place of business or residence, right? That is your non-resident taxable person. 278 is non-taxable supply. Supply of goods or services or both, which is not leviable to tax under this act or under the IGST. Supply of goods or services or both, which is not leviable to tax. Fine, that is very clear. Output tax in relation to taxable person is tax chargeable under this act on taxable supply or both, excludes tax paid on the reverse charge basis. Output tax also is very much the same, but it doesn't include the tax what is paid on the reverse charge basis. Output supply also very similar definition, simple definition. Outward supply, supply of goods or services, sale, barter, exchange. We have seen all these topics in our section 7 of the CGST in the supply chapter. Made or agreed to be made in the course or furtherance of the business. Zero rated supply, as we have already covered, it's defined, is not defined to section 2, but is defined in section 16 subsection 1 of the IGST Act. So zero rated supply means any of the following supplies: export of goods or services, or supply of goods or services, or both, to special economic zone or a developer or special economic zone. Fine. So I hope these definitions are clear to everyone. Any further queries? Sir, if treadmill is used for welfare of employees in office and also other sports equipment, see, it's a very, very difficult thing to justify whether it is used for business purpose, even though it is purchased for the purpose of the employees. We cannot say it is in course or furtherance of the business. It is like an added attraction that you are giving in your office by way of giving this for the purpose of usage of the employees. So we never know whether this can be allowed. But you can take this stand, but definitely it will be very, very litigative, because for non-business purposes, it is totally not allowed. That is what is given in 7. We'll discuss all these points when we go to 17 subsection. All the blocked credits are covered in that particular. Now we come to section 16. Input tax credit chapter. Section tax credit. Section 17 talks about apportionment rules and blocked credits, and section 18 it talks about the various ways in which the input tax credit can be shifted when the constitution of the person changes. That is, if you are changing from regular scheme to composition scheme, or from composition scheme to regular scheme, how do you determine how the input tax credit is carried forward is covered under section 18. These are the 3 important sections in our input tax credit discussion. Out of this, rules 36 to 45 are also there. In which rule number 42, rule number 43, rule number 36. These 3 rules are important. Rule number 36 has some important amendments. 16 also has some important amendments which are not there in your study material, but it is there in the supplementary study paper. Supplementary study paper has given it in a very brief manner. I have tried my best to explain it to the best of my knowledge. We'll also cover one example which you can definitely expect in your examination. There is an amendment in section 16 as well as the rule number 36. So what does 16.1 say? Let's first look at what it says. Every registered person shall, subject to the conditions and restrictions as may be prescribed and in the manner specified in section 49. Such conditions and restrictions, what are the conditions and restrictions? We will see in section 17. And in the manner specified under 49. What is the manner specified under 49? Order of claiming the input tax credit. First CGST to go, SGST to go. There is a method of set off which is being prescribed. Okay, in that particular manner, you shall take. It shall be entitled to take the credit of input tax charged on any supply of goods or services or both, which are used or intended to be used in the course or furtherance of the business. So every person subject to restrictions and manner specified under 49 will be entitled to take the credit of input tax on any supply of goods or services. But the most important point is it should be used or intended to be used in course or furtherance of the business. He need not actually use it. The intention to use also is sufficient. Example. Now, you have one, you have opened one software development company. You purchased 10 laptops, but you have only 4 employees. 6 laptops are idle. Can we claim the input tax credit on the 6 laptops? Definitely you can claim. It is not like just because you're not using the laptops, you cannot claim. The intention to use is there. So he has purchased the laptops, he can claim the credit. Whether he's actually using it or not, doesn't matter. And the said amount shall be credited to the electronic credit ledger. In the chapter Accounts and Payment of Tax, you will see the concept of 3 types of ledger: electronic cash ledger, credit ledger, and liability ledger. Now we will focus only on the credit ledger, which basically, if you're taking the input tax credit, it goes and sits in your electronic credit ledger, which is there in your GST portal. And from this amount, the GST is automatically adjusted towards the payment of GST. So therefore, the moment you claim the input tax credit, that particular amount will be credited to the electronic credit ledger of such person. I hope this is clear. Then 16 subsection 2. Notwithstanding anything contained in this section, no registered person shall be entitled to credit input tax in respect of supply of goods or services or both to him unless. So 16 subsection 2 speaks about the conditions for claiming the input tax credit. Please make a note of it, very, very important. 16 subsection 2 speaks about the conditions for claiming the input tax credit. What are the conditions to be satisfied? First one, he should be in possession of a tax invoice or a debit note issued by the supplier, registered under this act, or such other tax paying documents as may be prescribed. So this person should be in the possession of a tax invoice or a debit note. What is a debit note? In case you have missed any supplies to be added in the tax invoice, some more payment is due to the customer, you issue a debit note to that extent. Fine, and recover. So debit note also should be there. So main important point, tax invoice has to be there. Tax invoice, what all has to be contained is given in rule number 46. Name of the taxpayer, name of the customer, GST number of the customer, address of the taxpayer, place of supply, multiple HSN code, SAC code, all these are supposed to be there on the invoice. So therefore, he should be possession of the tax invoice or a debit note or such other tax paying documents as may be prescribed, and he has received the goods or services or he has received the goods or services or both. So that means he cannot claim the input tax unless first he should be in a position of the tax invoice or a debit note or any other document, and he should have actually received the goods or services. He should have received the goods or services. Only then he can claim the input. It shall be deemed that the registered person has received the goods where it is delivered by the supplier to the recipient or any other person on direction. Now, what is this bill to ship sub transactions? Bill to ship transaction. That means you must have seen this bill to ship transaction in place of supply discussion also. Now, when I am selling to a person, when I am procuring from a person and I am selling to the other person, let us take an example. I am procuring from a person in Delhi. I am selling to the person in Gujarat. So I tell that person, you don't send it to me, to send it directly to the Gujarat customer. So I am purchasing from the Delhi person and I am selling to the Gujarat person. For convenience sake, I am telling that person, I will procure from you. You raise the invoice on my name, but you ship the products to that person and I will raise the invoice on that person's bill to ship transaction. So in this particular situation, obviously this person need not receive the goods because the goods are directly gone to the third party. So therefore, even if the goods are going to the third party directly, it is deemed as if this person only has received the goods. That is what is the explanation which is given here to 16 subsection 2. Third one, subject to the provisions of section 41, the tax charged in respect of such supply has actually been paid to the government either in cash or through utilization of input tax credit admissible in respect of the said supply. Subject to the provisions of section 41 means under section 41, we have to make sure that the tax is paid. There are a way of set off as to how the tax has to go to the government. So subject to those provisions, the tax has to be paid to the government either in cash or utilization of input tax credit. Only then the input tax credit can be taken. So just because you pay through the customer, doesn't matter. The tax has to be paid to the government, right? He has furnished the return under section 39. Return also has to be filed. How the return has to be filed, how the credit he has to get, that we have to see. There is also another provision which is given where the goods against installments, last lot of the installment. So if different installments or lots are coming, only on receipt of the last fine. Any further queries here? Sir, in corporates, proper gym is existing for the employees. ITC not available. Again, same answer. Will you be able to justify that it is for business purpose? If you are able to justify that, there is specific blocking which says that sports equipment what office is buying for employees is blocked. But there is a clause which says that it should be used in the course or furtherance of the business. If you are able to prove that, you can claim the input tax. Here for the employees, if treadmill is bought, that means for enabling the productivity of the employees, I have brought the treadmill. If you are able to substantiate that, employees are working for long hours to make them encouraged and all of that, I bought. Then you can claim the input tax credit. But definitely it may be a litigative. There is no clear-cut conclusion in law whether the ITC is available or not for such cases. Yeah, another provision where the recipient fails to pay to the supplier of goods or services other than the supplies on which the tax is paid on the reverse charge basis, the amount towards the value of the supply along with the tax payable within a period of 180 days from the date of issue of invoice by the supplier, an amount equal to the input tax credit availed shall be added to the output tax liability along with the interest. What does this mean? That means you are a recipient. You claimed input tax credit, but you didn't pay to the supplier. First of all, you are violating the condition. You are paying to the supplier. Here, what is happening? Recipient fails to pay to the supplier of the goods or services. Amount of value along with the tax payable. Supplier issued the invoice. Supplier issued the invoice because as per the time of supply, the supplier has to pay the tax. The tax cannot be put on hold. So as per the date of invoice, supplier has paid the tax. You claimed the credit, but you did not make the payment to the supplier. So if he fails to pay to the supplier of goods, other than reverse charge is not covered. Forward charge only is covered. So he fails to make the payment of tax within 180 days from the date of issue of invoice by the supplier. How much ever input tax credit this person has availed, this recipient, shall be added to the output tax liability along with interest, right? 180 days he has to make the payment, otherwise it will be added to his output tax liability along with interest. Provided the recipient shall be entitled to avail the credit on payment made by him. But however, subsequently, if he makes the payment, then he can claim the input tax credit. I hope it is clear. Subsequently, if he makes the payment, he can claim the input tax credit. Now, these are the amendments which are very, very important. Addition of clause AA to section 16 subsection. Amendment was done in Finance Act 2021. Definitely applicable, covered in your supplementary study paper. It's not there in the material, but it is there in your supplementary study paper. Now, you need to know a brief history here in case you want to understand this properly. When the GST law first came in 2017, let me see if I have that slide here so that we go there and we'll come back again. Yeah. Now, I just want you to look at this slide and then follow what I'm saying. First, when 2017, when GST first law came into force, The government wanted the dealer or the taxpayers to file 3 returns: GSTR1, GSTR2, and GSTR3. Wherein GSTR1 is basically the return showing the outward supplies and the taxes declared on that, which is paid by the supplier. The moment this GSTR1 is filed by the supplier, the recipient will see the data in his GSTR2. He has to confirm the same and file the GSTR2. Once he does that, GSTR3 is nothing but sales in GSTR1 minus purchases in GSTR2. This was basically what the government wanted to do. But later, once the portal came into existence, it became very confusing. So the government decided, instead of doing all of this, let us have something called as a GSTR3B, which just says total sales is X, total purchases is X, and sales minus purchases, you pay the GST. GSTR3B, very, very simple. So GSTR2 was not there. It never came into existence. And GSTR1 was there showing the sales, and GSTR3B was there. So therefore, 2 returns were there till 2019. What started happening was there was no control on claiming of input tax credit, because conditions are what? He should be in the possession of the valid document. That condition is already satisfied. And then he should have supplied the goods or services. Okay, within 180 days, the payment also is supposed to be made. That also is completed. Fine. But so therefore, these conditions are satisfied. So that means the input tax credit was eligible. So people started claiming the input tax credit left, right, and center. This was what started happening. So therefore, to plug this loophole, the 2 forms of GSTR2A and GSTR2B came into existence. So this was there between 2019 to 2022. So that means the emphasis was on filing of GSTR1 of the supplier. That is, I am a supplier, I am filing the GSTR1. Immediately, the details will get populated in the recipient's GSTR2A. Recipient's GSTR2A. So I am supplier A. I filed the invoice of say 1 lakh at the rate of 18% GST. That customer is B. In that customer B, he can see that 1 lakh and 18% there. And based on that, he will claim the credit. The law between 2019 to 2022 said that maximum variation between how much you are claiming and how much is reflected should be 20%. That means if I am claiming 1 lakh, at least 80,000 or rather at least 85,000 should be visible on your GSTR2A. Up to 20% variation was allowed. Later, what happened? This 20% got reduced to 10%, and the 10% finally got reduced to 5%. That means the variation could have been only 5% and not more than that. Then 2022 onwards, the final amendment, it totally said there is no variation, nothing. It should totally be as it is, as per the GSTR2B. Now, 2A is separate and 2B is separate. What is 2B? What is 2A? 2B, the moment supplier files the GSTR1, it gets before the 10th of the month. Very, very critical point. GSTR1 has to be filed by 10th of the succeeding month. Before 10th of the succeeding month, he files the GSTR1. It will appear in the GSTR2B of the recipient after 13th. 3 days time is there for the systems to get updated. So before 10th, this fellow files. Before 10th or 11th, in some cases 11th also is the due date. He files by 10th or 11th. It will appear in the GSTR2B after 13th. Very, very simple rule now. Whatever is appearing there, only that you can claim. No question of any variation. You have the facility to change it, because sometimes what happens, you are also importing the goods. If you are importing the goods, there is no question of updation in the 2A, because imports is charged by the customs. So therefore, facility to edit in some cases are there. You edit it, but if you fail to provide an explanation for that, you are in for trouble. The entire thing will get added to the output tax liability along with interest. So this is basically the story. So therefore, just to give you an example here as to how it is now. First step, first case in this case study, supplier A sells the product worth 1 lakh to dealer B. Both are registered under GST. Rate is 18%. Supply took place during January 2023. Supplier files a GSTR1 or IFF. IFF is basically for, in certain cases, that is turnover which is less than 1.5 crores. The returns, if you want, the taxpayer can file the returns on a quarterly basis. In case returns are being filed on a quarterly basis, just because the recipient has to get the input tax credit, a facility of IFF is given to such quarterly taxpayers. IFF means invoice furnishing facility, wherein he can just disclose the invoices, very similar to GSTR1. So his supplier should file the GSTR1 or IFF before February 10th, mentioning the GST number of dealer. Once the GST number is filed, in the dealer B GSTR2B, data is auto-populated, automatically applies. And in GSTR3B return also, automatically it applies. So therefore, the conclusion is the dealer who is getting the credit is totally dependent on filing of supplier GSTR1 on time and updation in the GSTR2. Very, very simple. You cannot get the input tax credit if the supplier defaults in his return filing. So therefore, there lies the very, very important thing. You need to undertake transactions only with genuine suppliers who have a very good history of filing the GST. How do you know? Online you can check which GST number, whether this person's, what is his history. That also there are websites which actually track the data and give the reports. Because if he doesn't file unnecessarily, my money gets stuck there. I will not get the credit of that. That is why it is very, very important to undertake the transactions with the suppliers who have a good history of filing the GST return. So this was what I just wanted to cover. Now we'll come back to our discussion. That is the basic section. So I hope you know as to what is the role which is supposed to be undertaken. Yeah, so once let's go back to our discussion here. So these are the two, first amendment is the GSTR1, input tax credit available only if the supplier has furnished the GSTR1 and such details have been communicated to the recipient. How it is communicated? Through GSTR2. Then 16 to another clause B is added. Input tax credit in respect of supply of goods or services is available to the registered person only if details of ITC is communicated under 38 has not been restricted. That means in GSTR2B, the total amount has to be disclosed. Only then the input tax credit can be filed. Fine. The corresponding amendment is taken place in section 38 also, which speaks about how the information has to be given. Let us see if any queries are there. Thanks for sharing beautiful information, Pratik. Thank you very much. Thank you very much for your kind words, Mr. Dilip. Yeah, because it is very important for me to explain you with an understanding because of the evolution of the input tax credit. If I just tell you what the law is, you will not understand on what basis the law was. In case there is an amendment, you need to understand what the law was before. Only then you'll be able to get clarity as to linking with what it has, what it is present and what it was earlier, right? So that was your section 16 subsection 2 with the respective amendments which has been added, and 16 subsection 3 where the registered person has claimed depreciation. This is an old provision which is continuing. Registered person has claimed depreciation on the tax component of the cost of the capital goods and the plant and machinery. Under the provisions of the Income Tax Act 1961, ITC on the tax amount is not allowed. That means you are purchasing a capital goods. You are claimed the depreciation on the GST portion also. You are purchased a plant and machinery for 1 lakh, 18% GST. You are claimed depreciation on 1,18,000. No input tax credit will be allowed. You have to claim the depreciation only on 1 lakh. Then you can claim the input tax credit. This is what is given under 16 subsection 3. 16 subsection 4. There this also an amendment has happened. Please note down, all these are very, very important from exam point of view. 16 subsection 4, the date has been changed. Earlier, the date was different. Registered person shall not be entitled to take ITC in respect of any invoice or debit note for supply of goods or services or both after the 30th day of November following the end of the financial year or date of filing the relevant annual return, whichever is earlier. Annual return is supposed to be filed in GSTR 9 before 31st December of the succeeding financial year. So financial year 2021-22 means you have to file your GSTR 9 before 31st December 2022. In case, so therefore, what does it say here? Input tax credit for financial year. So if you're looking at financial year 22-23, the maximum time limit for claiming input tax credit is 30th November 2023. Or in case you have filed off your annual return before itself, you filed your annual return say in October 20th, 2023, that is the last date. So either of these two dates, whichever is earlier, is to be taken as the last date for claiming the input tax credit. So before this period was due date for the month of September. October 20th was the date before. That has now changed. Instead of clearly giving some due date and not mentioning the date clearly, now in 16 subsection 4, the date is mentioned accurately, which says 30th day of now. Fine. Now we just go to the respective rules also, which speaks out. Here also some minor amendments have been undertaken. Let's look at that also here. Again, input tax credit shall be availed by the registered person on the basis of any of the following documents. First one, invoice issued is by the supplier of goods as per the provisions of section 31. 31 talks about how the invoice has to be issued and the contents of the invoice. Invoice issued as per 31(3)(f) subject to the payment of the tax. This also different types of invoices, payment voucher for RCM, all that is covered. Debit note, bill of entry, customs in case you're importing the products, the bill of entry evidences the payment of IGST. Input service distributor, any other document in accordance with Rule 54. Input service distributor also will give the document evidencing the distribution of input tax credit on the basis of which you can claim the respective input tax. So therefore, the main amendment here is one particular line which referred to GSTR2 is deleted because GSTR2 is no longer relevant in any way. So therefore, now input tax credit shall be availed only if all the applicable particulars as specified are contained in the document. So therefore, whatever particulars as required to be mentioned in the tax invoice have to be totally given in the respective documents, then the input tax credit is claimed. But GSTR2 is furnished. This line is no longer applicable. Said document does not contain all the specified, but contains the details of amount charged, description, total value, GST, and in case of and a place in case of interstate supply, ITC can be availed. Sometimes due to certain overlap or due to clerical errors, sometimes all particulars are not mentioned, but some critical particulars are given, like amount of tax charge, description of the goods or services, total value of the supply, GST number, place of supply in case of interstate supply. If these details are given, still the ITC can be availed. That provision also is given. Then 36(3) speaks about tax that has been paid in pursuance of an order where demand has been confirmed on account of fraud, willful misstatement, or suppression of facts. Therefore, in this particular situation, where the tax has been paid, where the demand has been confirmed due to some fraud or willful misstatement, he paid some demand. No input, he paid some tax due to this, due to a demand notice. Input tax credit is not allowed as per Rule 36(3). 36(4) also very, very important amendment, what we just discussed in the few minutes back. No input tax credit shall be availed by the registered person in respect of invoices or debit notes, the details which are required to be furnished, unless the details are given in GSTR1 and the details of the input tax credit or debit notes have been communicated in form GSTR2B. GSTR2B has to be clearly visible. Only then input tax credit is billed. The corresponding amendment is made in Rule 36, Rule 4 as well. Fine. So I hope these points are clear. Before it was due date for the month of September. Due date for the month, due date of the return filed for the month of September. So that was October 20th was the date at that point, particular point of time. Anyways, now we have to see what is the actual date. Actual date is 30th November now. Forget about what it was before. Rule 37(1). Registered person who has availed the input tax credit but fails to pay the amount value of the supply along with the tax payable within the time limit shall furnish the details for the month immediately following the date of 180 days. Forget about GSTR2 here. It is not relevant here. Whenever he has availed the input tax credit, but he did not pay within 180 days, whenever he pays after 180 days, he shall clearly indicate the value not claimed and the respective input tax credit which was availed, which will be clearly given. However, values of supplies made without consideration shall be deemed to have been paid for the purpose of 16(2) provision. We'll discuss what this is as well. In case the GST is applicable on that, on that situation also, it shall be deemed to have been paid. Fine. Then 37(1) speaks about, provide further that value of supplies on account of amount added in addition to 15(2)(b) shall be deemed to have been paid for the purpose of 16(2). These are all technical provisions which speaks about in case you have not paid the respective tax, not followed the rules. Later, when you pay the tax, what has to be done? Rule 37(2) also tells the same thing. Input tax credit what you have not claimed earlier shall be, in case of the conditions not being fulfilled, shall be added to the output tax liability. In case you have claimed but later the conditions were not fulfilled, like 180 days you have not made the payment, it shall be added to the output tax liability. Of course, apart from the regular addition of input to the output tax liability, interest also will be applicable. Under 50 subsection 1, interest has to be paid from the date of availing the credit till the date of which amount added to the tax liability. These are all old provisions only. It is continuing to apply. Time limit shall not apply for claim for reavailing the credit. That means that whatever time limit of 180 days is there, if you did not make the payment of tax till 180 days, you are supposed to pay the output tax liability. Later, whenever you make the payment, you can claim the credit. For that, there is no time limit which is applicable. That is what this particular rule says. Fine. So that was your section 16. We'll again go through these clauses and understand as to what exactly it means. Subsection 1, as I told you, registration is mandatory for claiming the ITC. Every registered person shall be entitled to the ITC, including inward supply. Goods or services to be used purely for business purposes. We discussed regarding this also in the course or furtherance of business. That phrase is very, very important here. So scope of definition of business very wide here. It is also an inclusive definition, right? Now, there is some clarifications which are made with regard to molds and dies, which is provided by original equipment manufacturer to the component manufacturer on free of cost basis. Now, here what happens is OEM is the person who manufactures the equipment. He provides certain molds and dies like accessories to the component manufacturer. Component manufacturer does the components based on the molds, dies, and other accessories. He sends that back as per the specifications of the OEM back to him. Now, whenever the molds and dies are owned by the OEM, that means he owns it and he provides it to the component manufacturer, where both are not related persons or distinct persons, free of cost he provides. It is not a supply because there is no consideration involved. No consideration involved, related person or distinct person means then GST is applicable. But here OEM has the components, OEM has the molds or dies. This OEM sends the molds or dies to the component manufacturer. OEM sends the molds or dies to the component manufacturer, free of cost. It is not a supply because they are not related or distinct person. Then, since the molds or dies are provided on free of cost by the OEM to the manufacturer business, no requirement of reversal of ITC availed on such molds and dies by the OEM. So therefore, since he is giving it free of cost, whatever input tax credit he has claimed, there is no requirement of any reversal here. That is what is the clarification which is given. But sometimes what happens, the contract between OEM and component manufacturer is only for supply of components made by using the molds or dies belonging to the component manufacturer. But the same has been supplied to the component manufacturer on free of cost basis. Then credit reversal will be applicable. That means here what happens? Component manufacturer, whatever molds or dies are there, the contract is only for the supply of components. In the earlier situation, it is different. In the earlier situation, if you see, he gives it on free of cost basis to the respective component manufacturer. Free of cost is giving, no need of any reverse. But in this case, this particular situation, he is not giving any free of cost because the molds or dies also belongs to component manufacturer only. That means he only uses his own molds or dies and he prepares the respective components and supplies to the OEM. Okay, so here what is happening? Component manufacturer supplies the components. Molds or dies also belonging to him. But the same has been supplied by OEM to the manufacturer on free of cost basis. Okay, so here what is happening? He owns the respective product. Okay, he owns the molds or dies, component manufacturer is owning that and is using that in making of the payments. But same what has happened, this OEM is supplying on a free of cost basis. That doesn't matter because in this case, OEM will definitely be required to reverse the credit as the same is not considered in the course or furtherance of the business. So main responsibility of molds or dies is of the component manufacturer. In that particular situation, if the OEM is giving further free of cost, then definitely he has to reverse the credit because it is not in the course or furtherance of the business. That is a small clarification which is given with regard to transactions between the OEM and the component manufacturer. I hope this point is clear. Concept of OEM is very, very simple. See, when the person, let us take an example of a phone. The person manufactures the phone. It gives the job of manufacturing certain components of the phone to a third party. And with regard to the components, some basic main accessories will be there, which the OEM will provide it to the component manufacturer. Component manufacturer, what they will do is they will build the components with respect to the specifications given by the OEM and send it back to them. And finally, it will form part of the main phone, which is original equipment manufacturer. That means mainly it shall manufacture the like for example, if you take the example of Apple phone is the original manufacturer of the Apple phone. What is there inside Apple can be given from some other component manufacturer also, but this OEM only will give that contract. That is your concept of OEM. 16 subsection 2, as we discussed, 4 conditions to be satisfied. Possession of a tax paying document, invoice has to be there, invoice issued by the recipient in case of reverse charge basis, that has to be there, a debit note issued by the supplier, bill of entry or similar document prescribed under the Customs Act, revised invoice document issued by ISD. All this we have seen. Document basis which ITC is being taken should have all the relevant particulars as prescribed in Rule 46. Fine, this is clear. With effect from 1st January 22, new clause AA has been added to 16.2 to stipulate a new condition for claiming the ITC. Very, very, very important from examination point of view. Input a tax credit in respect of the supply of goods or services is available only if the details of the debit or credit note in respect of the said supply has been furnished in statement of outward supplies, and such details are communicated in the manner given under section 37. Right, in GSTR 2A or 2B, it has to be given. So consequently, Rule 36.4 also has been substituted. All that percentage, 20%, 10%, 5% no longer applicable. It is very, very clear. Substituted 36.4 is very, very clear. No input tax credit shall be availed by a registered person in respect of invoices or debit notes, details which are required unless the details are given in GSTR1 and details has been communicated in GSTR2B. Therefore, simple conclusion, ITC can be claimed only on invoices or debit notes whose details are reflected in the GSTR2B only when the respective vendors have filed the details of such invoices in the GSTR1. Finally, the matter has been put to rest that very clear. You totally have to depend on the suppliers for claiming your input tax credit. However, let me reiterate, this was definitely not the intention of the GST law when it first came. When it first came, it very clearly said, in fact, the late finance minister, Mr. Arun Jaitley, at that time, I still remember, he had given a tweet on Twitter. He clearly said that GSTR 2A is only for viewing the credits and reconciling with your books. It will not form part, does not relate to claiming of ITC, is what he very clearly said. So I can tell with pure conviction that Mr. Arun Jaitley ji was totally against this concept of claiming only as per 2A or 2B. This after Ms. Nirmala ma'am came into his existence, she wanted to exercise more control on these fake invoices and claiming of input tax credit, which is why Rule 36(4) has become stronger over the years. After COVID came, it first started after the first wave of COVID, because in the wave of COVID, the government could actually spend some more time as to regarding the rules of the input tax credit, and gradually now in 2022, it has become the most strict provision that it totally depends on whatever the supplier is giving. Then 110/2022 new clause BA also has been availed. ITC can be available only if it is communicated to such registered person, if the details of the input tax credit in respect of the section communicated to the registered person under section 38 has not been restricted. That means ITC will be available to a registered person only if unrestrictedly is able to view the credits which are available in your GSTR. So to see what exactly are these in returns chapter, you'll anyway see what are those returns and all, but let us assume what is all this. GSTR1 is a monthly or quarterly statement which talks only about the outward supplies. Such outward supplies are communicated in GSTR2A. What is 2A? 2A keeps changing. That is, sometimes you upload your GSTR1 after the due date. Your 2A will change, but your 2B is fixed. 2B is static, whereas 2A is dynamic. 2B on 13th is fixed. You can claim only that. Sir, what if my 2A is more than the 2B? Can I claim it still? No, you cannot claim. Next month, your 2B will be updated. That time you claim. I hope you got the point here. So 2B is auto-drafted ITC statement. IFF is, again, as I told you, invoice furnishing facility given to the quarterly taxpayers who are in QRMP scheme. Quarterly return, monthly payment. It's a new scheme which is given to a category of taxpayers who can file their return 3B, but payment they have to do monthly. Fine. Let us take an example. A question on these lines can be expected. During December 2022, supplier A having GSTIN of 36 ABC makes a supply of goods worth 15 lakhs to supplier B having GSTIN of so and so. CGST and SGST at 9% are applicable. And so in this case, you may ask as to what is the modalities of claiming the input tax credit. So there may be a question asked wherein GSTR1 for everything is not claimed. So how much credit you will get? It's very clear. If he files the credit on GSTR1 of 2,70,000, details will be visible on supplier B of January 13th and GSTR2B. ITC can be taken only if the GSTR is visible. If GSTR is filed later, it cannot be taken in January, but can be taken in February, because only then the GSTR2B will be updated. So 36(3), in case of fraud, etc., if any tax is paid, there is no question of any input tax credit. Then restricted ITC on invoice or debit notes not uploaded in the GSTR1. Some taxpayers take inflected or bogus ITC even if proper tax invoice are not available. In this case, restrictions are there. Very, very simple. All details of invoices, debit note should be given in 2A and 2B. Only then it can be claimed. Atlas Private Limited is a example here, manufacturer of taxable goods. It has received 50 invoices for inputs and input services from various suppliers during the month of September. Invoices involve ITC of 5 lakhs. Suppliers have purchased in GSTR1 for 40 invoices involving ITC of 3 lakhs as on the due date of filing the GSTR1. What is the ITC available? ITC available will be straight away of 3 lakhs. Whatever is GSTR1s are filed, only to that extent your ITC will be available. The same question earlier also was there in the study material, but in that case, a percentage has to be worked out because at that point of time for that attempt, it was the 20%, 5% rule is applicable. So therefore, when you're going through your study material, please make sure that these questions don't go past per the solution given in the study material because the rule has been amended now. I hope I'm clear. So what are the conditions? You must have received the goods or services. Bill to ship model also is covered. As I told you, delivery to other person on direction of the registered person if it is made by transfer of the goods or transfer of documents to title, then also it is covered. ITC will be available to registered person on whose order the goods are delivered to the third person. Examples here: A is a trader who places an order on B for a consignment of soda ash. A receives a buying order from C for the same quantity of soda ash. A instructs B to deliver to C and in turn raises an invoice on C. Here physically the goods don't come to the premises of A, but that doesn't mean he cannot claim the input tax credit. He can definitely is eligible to claim the input tax credit as well. Then registered head office New Delhi of ABC enters into a contract with DEF of New Delhi for repair and maintenance of computer systems installed at its registered branch office. DEF issues invoice on ABC for the services provided by it. This is also very simple. The repair and maintenance can be undertaken in Bangalore or Karnataka, but contract is entered into by Delhi to New Delhi. So therefore, in this particular situation, it doesn't mean that the services have to be received by Delhi. Wherever it is performed, the ITC definitely is being available. Whatever tax leviable should be actually paid to the government, either by cash or the utilization of ITC as per time of supply. The supplier has to pay. Whether the recipient is paid the amount or not doesn't matter. A lot of people in now also in the business community, they say that when that person is not paying the tax, what do? I should claim the input tax credit because I've paid it to him. So why should I be remitted? So therefore, in this particular situation, there is no clarity as such amongst the regular businessmen here. Fine. Even if recipient has paid the tax to supplier, his claim for ITC gets confirmed only when the supplier deposits the tax so collected by him to the government. So very simple. So claim of ITC will come when only when the supplier deposits the tax. Supplier files the GSTR1, you get it. But is GSTR1 the total proof of depositing the tax? Definitely not. Because what if the supplier in GSTR1 discloses the tax and in GSTR3B he doesn't pay the tax? The situation also will come. But now the government has become even more strict. It says that whatever disclosed in GSTR1 will be there in GSTR3B automatically. If you change it or anything, immediately the systems are programmed to generate a notice to you, and again you will face a problem. All 4 conditions to be satisfied for claiming ITC. Filing of return is there. He should registered person claiming the ITC must have filed the return. Presently, GSTR 3B is being filed. So 3B ITC is required to be filed for availing the input tax credit. Single consignment received in lots or installments. Only once you receive the last lot, you can claim the credit. Like example, XYZ enters into a contract with ABC for supply of 10 metric tons of chemical for 1,18,000 month of August. Chemical is to be delivered in lots over a period of 3 months. ABC raises the invoice for the entire amount in August, and XYZ also makes the payment. Supply is completed in November. So only once the supply is completed in November, you can claim the input tax credit whenever the goods are supplied in lots. This is rule 37. As we discussed, payment for the invoice to be made within 180 days. Registered person must pay the supplier the value of the goods or services along with the tax within 180 days from date of issue of the invoice. If you don't pay within 180 days, credits whatever have been taken will be added to the output tax liability along with interest. Interest rate as per 15 subsection 1 is 18%. 18% interest will be applicable on per annum will be applicable. So per month that comes to around 1.5%, right? From the date of availing the credit till the date when you actually is added to the output tax liability is paid, the interest is calculated. Once payment made, credit can be availed. Part payment entitles proportionate credit. So once the payment is made, the immediate credit can be availed. Condition for payment within 180 days will not apply in case of reverse charge mechanism, because you yourself pay the tax when it comes to reverse charge mechanism. So that 180 days concept will not come. Deemed supplies without consideration, here also that payment will not applicable, because again there is no consideration, you yourself pay the tax. Additions made to value of supplies on account of suppliers in relation to such supplies being incurred by the recipient of that supply. What does this mean? Sometimes there may be a contract wherein the supplier does not follow the rules of the contract, due to which the contract says a further fine has to be added. So due to which the value of the supply increases. For that also their 180 days restriction will not apply, because that is something which has increased after the respective contract has been entered into. Again, tax component depreciation, ITC is not allowed here. On capital goods and plant and machinery, you claim the depreciation on the tax component. ITC will not be allowed. Dual benefit cannot be claimed under ITC and GST. Therefore, either depreciation on tax component or ITC of such tax has to be claimed. Okay. Again, here it is September only. Just ignore that wording here. It is November. Ignore that heading here. Time limit for availing. It is not due date for the filing of return. It is straight away 30th November. So ITC can be claimed at any time till 30th November of the succeeding financial year. Recent amendment, very, very important from examination point of view. When we work out some problems in our last class in ITC, I'll draft some new problems with regard to the new amendments which are not there in your study material, so that it is useful for you from the exam point of view. So therefore, ITC on invoices relating to invoices can be availed anytime till 30th November of the succeeding financial year, or the actual date of filing the annual return, whichever is earlier. However, the time limit will not apply for reclaiming the credit. Reclaiming credit can be, which has been reversed, can be claimed anytime. No time limit is applicable. Again, a question on time limit for ITC here. Hercules Machinery delivered a machine to XYZ in January under invoice 49 dated 28th Jan, 4,15,000 plus GST, undertook trial runs calibration as per requirements of XYZ. Amount chargeable for post delivery was covered in a debit note of 50,000 per GST. Okay, now this debit note was not covered. Hercules Machinery did not file its GST, did not file its annual return till October. What is the time limit for ITC? Annual return whenever it files, or 30th November, whichever is earlier. To that extent, in case you have raised a debit note, you claim the input tax credit, you can still update the debit note till these particular dates. So this slide we have already covered. I hope everyone is clear as to how the evolution of ITC mechanism has happened in the GST law. Fine. So before we start section 17, let us take a short break. Meanwhile, let me see if you have any queries. Before 11th, GSTR want to be filed by supplier to get ITC reflected into before other than Q. Yes, very true. 10th or 11th, because usually in our office, I tell one day before only to our boys, so that there is no missing of return filing. That is why it's always fed in my mind as 10th. Sir, if RCM tax is paid and you claim same RCM in the same months, how that will be reflected in 2A? RCM will not be reflected in 2A. Why? Because RCM, you pay it on your own and you pay it in cash. Through the cash ledger, it goes. How the mechanism happens is, RCM input, there is a separate column in your GSTR 3B. First of all, RCM will not come in GSTR 1. Remember that, because RCM is on your expense. On your expense, you calculate the tax and you make the payment. So first thumb rule, RCM will not come in your GSTR 1. It will come only in your 3B, because RCM is always on your payment. there is a separate column which is given for RCM, wherein you have to make the payment. You have to make the payment through the cash ledger. The moment you enter that amount, immediately the person will ask you to pay that amount. You make that payment and then you claim it as a credit again down. So therefore, it once appears on top where I input in RCM column box, and down it again appears under other ITs. So therefore, both gets reconciled. So ITC, RCM and 2A have nothing to do with each other. Don't worry. Because, and the column where you mention also ITC, RCM is different, regular ITC is different. So don't worry about not reflecting the 2A. Fine. I hope you are clear on this. Okay, let's take a short break and then we will come back and we will discuss the further points. We'll be back in the next 10 to 12 minutes. Thank you. Welcome back, everyone. So therefore, that was section 16 till now. Let me just look at some further queries which have come up. If RCM tax is paid and you claim same RCM in the same month, yeah, this we have already covered. Sir, from books of accounts as auditor, how we determine the assessee is liable to pay RCM but not paid? You have to look at the expenses which are there in the P&L account. Expenses which relate to RCM, like security services, legal fee, and sponsorship services. So in such particular things, RCM will be applicable. So you'll have to look at the books of accounts and the respective GST returns and check whether the RCM was paid. So as an auditor, you'll have to look at the items of P&L in case you want to get clarity as to when the RCM was paid or not. So now we come to section 17, which talks about apportionment of credit and block credit. Apportionment of credit is a slightly complex, I won't say complex, but there are certain rules in which you have to follow. When I say apportionment of credit, we look at two situations. One, when the credit is used for taxable supplies and exempt supplies both. In case there is a common input tax credit, how to identify how much credit can be taken and how much credit has to be reversed. And also with regard to capital goods, in case of input services which are used, and also for capital goods which are used, how we have to obtain. And also a situation where the inputs are used for business purposes and non-business purposes. It's a common input. You're using it for the business purpose as well as the non-business purpose. How to avail that in that particular situation will be covered here. So let's first look at the section and then we will study the rules which are associated with that. 17 subsection 1. Where the goods or services or both are used by the registered person, partly for the purpose of any business and partly for other purposes, the amount of credit shall be restricted to so much of the input tax as is attributable to the purpose of his business. Very simple. That means if you are using it partly for business and partly for other purpose. So 17 subsection 1 speaks about business and non-business. If you're using for business purpose and for non-business purpose, whichever, how much ever is attributable to the business purpose, that credit only shall be restricted. It shall be restricted to the credit. It shall be restricted to the amount of input tax as it is attributable to the purposes of his business. 17 subsection 2 talks about taxable supplies and exempt sub. First, so 17 subsection 1 speaks about business, non-business. So whichever attributable only to business purpose, it has should be taken. 17 subsection 2, where goods or services are both used by the registered person, partly for affecting the taxable supplies, including zero-rated supplies under the Act or under the IGST, and partly for affecting exempt supplies under the said acts, the amount of credit shall be restricted to so much of the input tax as is attributable to the said taxable supplies, including zero-rated supplies. So you have input. You're using it for you're affecting taxable supplies, including zero-rated and exempt also. Credit which is attributable only to taxable, including zero-rated. So taxable zero-rated, if you are directly attributing input tax credit, you can claim. Only that has to be claimed is what section 17 subsection 2 say. 17.1 speaks about business, non-business. 17.2 speaks about taxable and zero-rated versus exempt. Fine. 17.3. How do you calculate the value of exempt supplies? What all has to be taken into consideration for undertaking the value of exempt supplies given in your 17 subsection 3. So value of exempt supplies as per 2 may be such as may be prescribed. It shall include the supplies on which recipient shall be liable to pay on reverse charge basis, transaction in securities, sale of land, sale of building. These 4 are the inclusions which have to be taken into consideration. Okay. Supplies on which recipient shall be liable to pay on RCM will be calculated in exempt supplies. Transaction in securities, sale of land, sale of building. All these shall be value of the exempt supplies. For the purpose of this subsection, value of exempt supply shall not include the value of activities or transactions specified in Schedule 3, except those specified in paragraph 5 of the schedule. See, Schedule 3, whichever neither supply of goods or not supply of services, it will not include that. But in that paragraph 3, that is before completion certificate, if you are getting the consideration with regard to works contract service movable property, that shall be that will not be covered in this. Others, it will not include the activities or transactions. 17 subsection 4 is an option is given to the banking company as well as NBFC, because banking company have multiple transactions, which have transactions by way of extending loans. It earns interest, it earns discounting bills, it earns discounts, it earns bank charges, it earns other low maintenance balance charges, ATM charges, SMS alert charges. Multiple income will be there. So therefore, it is very, very difficult for a banking company to identify as to which expense relates to the taxable supply and which relates to the exempt supply. And therefore, there is an option which is given to the banking company. Any banking company or an NBFC which is supplying the services by way of accepting the deposits or extending the loans on advance, either first it shall comply with the provisions under subsection 2, which is whatever is the provisions which is given here, which we discussed in the previous slide. It will comply with those provisions, or every month it will avail 50% of the eligible ITC. Okay, so every month what it will do, it will calculate the eligible ITC which is there. Straight away 50% I will eligible, rest shall lapse. So rest is not eligible, you cannot claim them. These two options are there to the banking. Once you exercise the option, you cannot withdraw it during the rest of the financial year. That is also very, very clear. And restriction of 50% shall not apply to tax paid on supplies made by one registered person to another registered person having the same PAN number. That means inter-branch supply of services. That means if the branch is supplying the services, the bank has two different branches in two different states. One branch is supplying the services to the other branch. In that particular situation, whatever GST is being charged by one branch to the other branch will totally be claimed as the credit. This 50% restriction will not apply in those cases. 50% restriction will not apply. So therefore, it shall continue as it is. Right? That was your 17 subsection 4. The most interesting and the most important part of section 17 is your blocked credits, which are covered in 17 subsection 5, which gives a list of cases, a list of scenarios where GST input tax credit is not allowed. So therefore, when the GST, in the GST law, input tax credit is being advertised as the most radical thing, the thing which will cause improvement in working capital and liquidity for the small taxpayers, when such a benefit is announced, there is always a possibility of the taxpayers not following the rules in letter and spirit, which is why something called as a 17 subsection 5 was needed. So 17 subsection 5 has identified certain specific transactions which the government felt were not eligible for claiming the ITC on the expenses made towards those items and those transactions. That is what is given in 17 subsection 5. Let us look at what all transactions are covered here. So input tax credit is not available in certain cases. First one, motor vehicles for transportation of persons having approved seating capacity of not more than 13, including the driver. Okay, so therefore first thing, we will come to the exception later. Very simple. Transportation of persons is the object, and motor vehicles for transportation of persons. Approved seating capacity of not more than 13. So 13 should be the maximum number of people who can sit in the motor vehicle. Then the input tax credit is not allowed, except where they are used for making the following taxable supplies. However, some exceptions are given where the input tax credit for motor vehicles can be claimed. First one is further supply of such motor vehicles. That is, if the motor vehicles, if you are a car dealer, you are procuring the cars and you are selling. You are a car dealer. Therefore, you are using that motor vehicle for further supply of such motor vehicle. Then you can claim the credit. Or transportation of passengers. You are using the motor vehicle for transporting the passengers from one place to the other. Then also the main purpose is transportation of passengers, right? Therefore, that means you are in that business, right? You are making the taxable supply. You are purchasing the motor vehicle. using it is as a cab, using it main purpose is transport of passengers, not transport of persons. That means if I buy a motor vehicle and I drive it, I am not a passenger in that. I am the person who is owning the car and driving. Who is a passenger? Who comes in the car and I charge some money from. He is a passenger. Transport of passengers, credit is allowed. Imparting the training on driving such motor vehicles. I purchased the motor vehicle and I am running a driving school. I am using that motor vehicle to be used by the student who is learning the driving. I am purchased it for that purpose. Then credit is allowed. So therefore, these are the exceptions. Further supply of such motor vehicles, transportation of passengers, or imparting the training on driving such motor vehicles. On these three aspects, it is very much allowed. Same like motor vehicles, vessels and aircraft are also covered. Vessels, that is your boats, ships, etc. Aircraft are also covered. Same exceptions are given, but another one is there for transportation of goods also. So vessels and aircraft, except when they are used, two things are there. First, for making the following taxable supplies: further supply of such vessels or aircraft, or transportation of passengers, or imparting the training on navigating such vessels, or imparting training of flying such aircraft. Very simple. Then the credit is allowed. Also, if vessel or aircraft is used for transportation of goods, then also the input tax credit is allowed. I hope this is clear. Next one, 17.5 AB also, it relates to the previous two sections only. There was a anomaly, or there was a doubt initially when the GST law came, that recurring expenses with regard to the motor vehicles like motor repairs, motor vehicle insurance, servicing, etc., whether these also will be covered in the blocked credits. Definitely, first explanation was given, yes, it will be covered, and later what happened, a particular clause also was inserted so that there is no confusion whatsoever. The particular clause also was inserted. The clause clearly said that general insurance, servicing, repair, maintenance, as far as they relate to the motor vehicles, vessels, or aircraft referred to in clause A or AA, you cannot claim the input tax credit. However, in case the motor vehicles or vessels, aircraft are used for the purpose which is mentioned in those two clauses, that is nothing but imparting training, further supply, etc., then you can claim. Okay. Or where services are received by a taxable person engaged in the manufacture of such motor vehicles or in supply of general insurance services. That means if I am the manufacturer of the motor vehicle, I spend for the insurance, I can get the credit. I am an insurance agent. I procure the insurance and I sell it to the customer. Right? Taxable purpose engaged is in the supply. So that means I'm an insurance agent. I have tie up with multiple insurance companies. So I take the customer, I get him signed up with the other insurance company. Whatever I pay to him, assuming I pay to that insurance company, that can be claimed as a credit because I'm in the supply of that business one. Fine. I hope this is clear. This was your 17 subsection AB. 17.5B talks about multiple goods or services, which in the opinion of the government have to be kept as a blocked credit. Multiple services are given. Let us go through that. Following supply of goods or services: food and beverages. Food and beverages means you go to a restaurant and eat, no input tax credit. You take your entire team for team lunch, team dinner, nothing. No input tax credit will come. Outdoor catering. You hire a caterer for your corporate event, no input tax credit. Beauty treatment. I don't need not explain. If you have some treatment for your face or your hair and all, nothing. Health services. Healthcare services are different and health services are different. Health services means I go to a gym, take a gym membership, no credit. And I go to some spa for some massage treatments, health packages, etc. Nothing. Cosmetic and plastic surgery. You don't like the shape of your nose, you want to change your nose, you go and get the nose changed. Again, this no credit, for no input tax credit. Leasing, renting or hiring of motor vehicles. Leasing, renting or hiring of motor vehicles. That means you're hiring the motor vehicles, that also input tax credit is not allowed. Okay, leasing, renting or hiring of motor vehicles not allowed, except when they are used for the purposes given in A and A, then you can take. Otherwise, life insurance, health insurance, no input tax credit allowed. There are very many queries from people of multiple quarters. For example, if you look at an actress who is acting in the movies, for an actress, the most important thing is how she looks on screen. So she goes and takes the beauty treatment or does the plastic surgery, and she says that it is purely related to my profession. Can I claim the input tax credit? No, specifically blocked in 17 subsection 5, unconditionally blocked. There are no conditions attached to it also. There are no conditions attached to it also. So therefore, it is very, very clear that you cannot claim the input tax credit no matter what. There is a provision which is attached to it. That is, if you are in the same type of service. Let me give you an example. Now I am a caterer. I am doing a marriage function. I have all the items in my menu, but I don't have gulab jamun, unfortunately. So what I do is I procure the gulab jamun for one local sweets vendor. He gives me a GST bill. I don't eat those gulab jamuns myself. I just put them in the function, procure from him, display function, the guest eat the function, I charge the guest. So this procurement of gulab jamun is an input service for the caterer who is in the same type of business. Who is in the same type of business. Very simple. Then it is allowed. That is what the proviso which says. Provided input tax credit in respect of such goods or services or both shall be available, where an inward supply of such goods or services or both is used by the registered person for making an outward taxable supply of same category of goods or services or both, or as an element of a taxable composite or mixed supply. It can be even as an element of composite supply. Same example we'll see. Event manager is doing the function. He takes care of everything, right from your photography, right from your catering, right from your stage decor and transport services for your guests. A to Z, it takes care of everything and charges. So that is, it is a basically, it can be a composite supply or a mixed supply. He gives the contract of photography and videography to a third party. That photographer, he gives an invoice. It becomes an input invoice, or caterer gives an invoice. It becomes an input invoice for this event person. Credit is totally allowed. I hope this proviso is clear. Then further supply. Membership of a club, health or fitness center, again not allowed. Travel benefits extended to employees on vacation, such as leave or home travel concession. If you give the travel benefits to this thing, but in case it is obligatory for the employer by any law, if any law says that you have to give, like Labor Act is there, it says you have to give so and so number of days, then travel benefits are there, ITC is available, and otherwise it is not available. Another important point number C, works contract service when supplied for construction of immovable property other than plant and machinery, except when it is an input service for further supply of works contract service. That means what? I am constructing a building for which I am procuring some works contract service. You cannot claim any input tax. What is works contract? Labor, cement, etc. for construction purposes other than plant and machinery. Plant and machinery you can claim. Okay, except when it is input service for further supply of works contract service. Again, what is an example? You have undertaken a construction contract. You are a construction contractor. Your customer said, you please build this as I want, I will pay you so much. So contractor gave that person a GST bill. He paid the GST. He will not get that input tax credit because it comes under the first thing, works contract service when supplied for construction. But this contractor, he will give labor contractor to someone. He will procure cement. He will procure steel. He will do whatever he wants. In that particular situation, whatever GST amounts he pays, he will get as an input tax credit, because the works contract service is used for further supply of works contract service. That is why he will be able to get the credit. I hope that point is clear. Then, goods or services are both received by taxable person for construction of immovable property, again, other than plant machinery, on his own account, including when they are used for the course or furtherance of the business. You are constructing an office for yourself. It relates to your business only. You are constructing office building, no input tax credit allowed, because it clearly says even if it is used for the course or furtherance of the business, you cannot claim. Now, why are all these kept here? Because the taxpayer may say, I am constructing the office, therefore I am claiming the credit. But in reality, the construction will be actually of his house. How will the GST department know whether he's constructing his house or the office? That is why this restriction is given. Again, the phrase expression construction is clearly includes reconstruction, renovation, addition, alteration, or repairs to the extent of capitalization. The next one, goods or services on which tax has been paid under section 10. So if you are procuring some goods or services on which the amount has been paid in composition scheme, no question of input tax credit. Goods or services are both received by non-resident taxable person. Who is non-resident taxable person? We saw the definition. Occasional transactions mainly located outside India. Except on goods imported by him. So goods or services which is received by non-resident taxable person, other than the goods imported by him, on that also input tax credit is not available. Goods or services are both used for personal consumption, right? Personal consumption, the treadmill example, what it? You bought the treadmill for your house. You bought one, say, what else I can tell you? You bought an iPad, but iPad you are using only for seeing movies in the night. It's not for personal consumption. Though you cannot say, I bought the iPad, I will use it for home purpose, but I will say that it is for business. Of course, the GST department has no means of verifying what you are doing with it, but I'm just telling about the law. That is the most important point. Today only there was a query which was asked by one of my clients who are into the business of flower decor as well as the business of digital marketing. They have two companies. Flower decor, basically they just sell the plants and sell the flowers to the clients, and therefore on that there is no GST exempt. But they have procured some particular decor items for this exempt supply. They asked me whether they can claim the input tax credit in their other form, which is in digital market. I said you cannot do that because this is related to the exempt supply. So therefore you cannot claim the input tax. So what will you do if you go ahead and still claim? It is a risk, because GST again is a self-assessment tax. The first stage of assessment is always done by the taxpayer. Even today, we may throw multiple allegations at the government or at the GST law, saying that the GST has done this, GST has done that, now there's no money to anyone and all of that. But still we in the country, we have people who claim the input tax credit on motor cars also. It is not allowed. You cannot claim that. Sir, it is reflecting in my GSTR 2B. So what? He as a responsible person files the GST return with your GST number. Just because it reflects in your GSTR 2B, it doesn't mean you can claim it. Eligible credit only must be claimed. Luxury cars, because the GST amount is huge. If you buy a car for 1 crore, your GST amount only goes into 15 to 20 lakhs. We have people in the country who claim even that. Oh, let us see if any notice comes, that time we'll respond. Is the general attitude. It is definitely not correct, because you are ultimately curtailing the growth of the nation by claiming this frivolous input tax credit. That is why the government has gone to that extent by putting the rules as linking the GSTR 3B with 2B and all of that. Otherwise, all these rules were not there before when the GST law first came into place. Fine. So that was this thing. Then goods lost, stolen, destroyed, written off, or disposed by way of gift or free samples. So if you have a goods, you lost it. If it is stolen, if it is destroyed, written off, or disposed by way of gift or free samples, all these things, no input tax credit. Let us take an example here. A person was into the purchase and sale of diamonds. This purchase and sale of diamonds here, what has happened? You have purchased the diamonds here. You had the stock in your business place. It was all stolen. All the diamonds were stolen. You went to the insurance company. It was under insurance. Insurance company said, okay, it is stolen. We will grant you this amount. You got that money. Most important point here. Don't forget to reverse the input tax credit, because when you procured the diamonds, you would have claimed the input tax credit. But these diamonds later were stolen. The moment it becomes stolen, you're not supposed to claim the input tax credit. So therefore, that has to be reversed. Sir, I got money from the insurance company. That doesn't matter. That doesn't matter. Insurance company will give you the money. Input tax credit cannot be claimed. Has to be reversed. Fine. Then any tax paid in accordance with the provisions of 74, 129, 130. Penalties and prosecution chapter, you will cover all of this. Section 74, fraud, detention of the conveyance, confiscation of goods. In all these aspects, any tax which is paid in accordance with that, you cannot claim the input tax credit. Fine, no queries till now. Let us look at this question here. ABC Co Limited is engaged in the manufacture of heavy machinery. Company procured the following items during the month of July. Electric transformers to be used in the manufacturing process. GST paid is 5,20,000. Trucks used for transport of material is 1 lakh. Raw material 2 lakhs. Confectionery items for consumption of employees working in the factory 25,000. Determine the amount of ITC available with ABC company for the month of July. Please try to work out this problem. Yeah. Sir, when we are giving us free samples and they refer it as business promotion expenses, when ITC has to be reversed. When you are giving us free samples clearly given under 17 subsection 5, you have to reverse it. No doubt about that. So here if you see electric transformers 5,20,000, no restriction given anywhere. So this ITC can be claimed. Trucks used for transport of material is 1 lakh rupees. Now here comes under the motor vehicles. In this case, there is no separate benefit for transporter of material. For vessels, it is given, but not for motor vehicles. So therefore, trucks for transport of material also cannot claim. For raw material, 2 lakhs you can claim. Confectionery items for consumption of employees working in the factory, food and beverages, total 25,000. That also cannot be claimed. Fine. So trucks used for transport of material is the confusing part here. But in motor vehicle, transport of goods is not given as an exception. Transport of passengers only are given. 17 subsection 6 talks about the government prescribing the manner in which the credit has to be distributed. Manner in which the credit has to be distributed is given under 17 subsection 6. How to distribute the credit? That is given in your rule number 42 and 43 as to how to calculate that. So we'll go through that as well now. So plant and machinery explanation clarification is given, means apparatus, equipment and machinery fixed to the earth by foundation or structural support that are used for making outward supply of goods or services or both include such foundation and structural support. But it excludes land building or civil structure, telecommunication towers and pipelines. The definition is given just for the understanding. Rule 38 speaks about the claim of credit by banking company or financial institution. As I told you, banking company or an NBFC which accepts the deposits, supply of services by accepting the deposits, extending the loans or advances, which chooses not to comply with the provisions of 17 subsection 2 will follow the following procedure. How it will do? The procedure is given here in the rule number 38, which is nothing but the 50% of eligible credits. First thing, it will not avail the credit of tax paid of inputs and input services that are used for non-business purposes. So this banking company, input services that are used for non-business services, it will not take. Any input tax credit is there which are not used for its business, totally not taken. The credit attributable to supplies mentioned in 17 subsection 5, GSTR2 is no longer there. That is blocked credits. You will not take. You will not take that credit. Fine. Then said company or institution shall avail the credit of the tax paid on inputs and input services referred to in 17.4 and not covered under clause A. So therefore, second provision, what was that? It spoke about the interbranch services. Interbranch services, total credit shall be taken. After all this, whatever is remaining, 50% of the remaining amount shall be the input tax credit admissible to the company, and the balance amount shall be reversed in GSTR 3B. Now, there was initial clause was it will subject should be credited to the credit ledger, but that is no longer applicable. Why? Because total credit now will be visible in GSTR 2A, GSTR 2B. GSTR 2B, the credit will be visible. The same credit will be auto-populated in your GSTR 3B also. So what you have to do, you have to first calculate. You should not take into account the non-business purpose. So remove that. You have to reverse that. Then blocked credits also will be there in your 3B. That also you have to reverse. But credit of what you can claim, interbranch supply of services credit, that you claim. So after you remove these non-business purposes as well as the blocked credits, whatever is remaining, 50% of that you claim. Balance amount you have to reverse in GSTR 3 because 3B is already mentioned, but down there is a separate column for reversal of ITC. So you have to reverse there in that, only then it will be done. Fine. I hope that is clear. Rule 42 speaks about the manner of determination of ITC in respect of inputs or input services and the reversal thereof. We'll just go through the rule today. It will be slightly a bit tricky to understand, but once we do some problems based on this in the coming classes, you will get more clarity with regard to that one. So first one, Rule 42 speaks about input tax credit in respect of inputs or input services and reversal thereof. So here we look at the inputs and input services only. Capital goods are not covered in Rule 42. Capital goods are covered in rule number 43. So in 43, once we go, we will study what exactly is the rule pertaining to capital goods. But inputs or input services is very, very clear. The inputs or input services, whatever the input tax credit is there, which attracts the provision of 17(1) and 2, partly used for business and partly used for other purposes, or partly used for taxable and zero rated and partly used for exempt supplies, you will attribute it in the following manner. How will you attribute it? First thing, total input tax involved on the input and input services, take it as T. T is what? Total input tax involved on all the inputs and input services, take it as T. Second one, out of T, the inputs and input services used exclusively for purposes other than business, take it as T1. Take it as T1. So total input tax on inputs and input services, you take it as T, which is anyways there in your GSTR 2B. Everything will be there in that. Out of that, whatever is used exclusively for non-business purpose, you have to identify that is your T1. T2 is exclusively for exempt supplies. And T3 is input tax credit as per blocked credits under 17 subsection Y. So therefore, what you are doing here, you are segregating the input taxes which you are not allowed to claim as a credit. What are those? Inputs used for non-business purposes, inputs used for exempt supplies, and third one, the inputs for which credit is not available under 17 subsection 5 blocked credits. So these three you have to take T1, T2 and T3. So total input tax, whatever is there under 2B is T1, T2, T3, non-business, exempt supplies and blocked credits. That is your T1, T2 and T3. So the amount of input tax credit to the credit ledger of the registered person is C1. Fine. So therefore, here is your T is the total input tax credit. How much goes to credit ledger should be your C1. How much input tax credit should go to credit ledger? It is nothing but total of input tax minus T1 plus T2 plus T3. Because T1, T2, T3 are not allowed. From the total, you deduct from T and the balance is goes and sits in your electronic credit ledger. This is the credit you are supposed to take first and then later reverse. So credit what you are taking first should be C1. Next point. Amount of input tax credit which are attributable to input and input services intended to be used for supplies other than exempt and zero rated supplies. That is total input tax credit which you can claim. Let us assume it is T4. So in C1, out of total input tax credit, you removed three types of input tax credits which you cannot claim. What all you removed? Non-business purpose attributable ITC. Second one is blocked exempt supplies related ITC. And third one is blocked under 17 subsection 5. This three you removed from the total, you are getting C1. Then what is T4? T4 is credit which is attributable, exclusive supplies other than exempt, but including zero rated, whatever is allowed, that is your T4. So therefore, T1, T2, T3, and T4 should be declared in the summary level. That is, the total has to be declared in your GSTR 3B. Then what happens? You will find out the common credit. What is the common credit? Common credit is nothing but C1, which is the total after the blocked credits, minus T4, minus whatever is the actual attributable credit, that is your C2. Once you get the C2 common credit, it becomes very simple. Input tax credit attributable to exempt supplies needs to be taken into consideration. That is your D1 is equal to E by F into C2. So whatever ITC is attributable towards the exempt supplies is denoted as a D1. And how will you calculate that? Exempt turnover by F, which is your total turnover, into C2. Into C2. That is your common credit. So therefore, C2 into E by F is nothing but your D1 input tax credit attributable to exempt supplies, which has to be calculated, where E is the exempt supplies and F is the total turnover in the state of the registered person during the tax period. Proviso is given to this particular rule, where sometimes what happens during the tax period, the turnover will not be given. That time you have to take the last tax period. If last tax period also not given, in that case you have to take the previous month for this particular situation. Fine. Aggregate value of exempt shall include the value of duty and tax under any. So other than GST, all the other taxes has to be taken into consideration. Then, so once you find the common, so where did we stop here? We came here, we found out D1, that is the input tax attributable to exempt supplies is D1. Now, similar way, you also have to find out D2, the next one, which is the credit attributable to non-business purpose. That it is very, very clear. The GST, the government says that credit attributable to non-business purposes, please assume it to be 5% of the common credit straight away. So straight away C2 common credit is there. 5% of that is D2. So D1 and D2. So D1 is for the exempt supply and D2 is for the non-business purposes. The remainder of the common credit, whatever is there, shall be the eligible input tax credit attributable to the purpose of the business and for affecting supplies other than the exempt supplies, but including zero rated supplies. So whatever common credit is remaining after this one shall be the eligible input tax credit. So from C2, you remove the D1 and D2. which is the credit attributable to the non-business purposes. That is your eligible input tax credit attributable to the purpose of the business. So here what will happen? This C3, eligible one, D1 and D2 will be calculated separately for the central, state and union territory tax and shall be declared in form GSTR 3B or form DRC 3. Then similar way, aggregate of D1 and D2 will be reversed by the registered person in 3B or through form DRC 3. Reversal also will happen accordingly. We'll see multiple problems based on this so that you get total clarity. Fine. So same way, amount of input tax used for purpose other than business has been identified, segregated at invoice level by the registered person. It will be as T1 and T2. Remaining amount will be shown under T4. Once you get the input tax credit under sub-rule 1, it shall finally be calculated for the financial year before the due date for furnishing the return for the month of September following the end of the financial year in the manner specified in the said sub-rule. So here what happens is, once for every month you do this formula and you work out the calculation, and at the end of the year, you do the aggregate of the total amounts, there may be a difference. How that difference will come? Where the aggregate of the amounts calculated in respect of D1 and D2 exceeds the aggregate of the amounts determined in sub-rule 1 in D1 and D2, such excess shall be reversed by the registered person. That means what? Whichever you calculate finally, if it is more than whatever the amounts you are doing on a monthly basis, whatever excess is there, you have to reverse it. The time limit is not later than the month of September. And if you reverse on that, interest also will be applicable. There will always be a reverse situation also. Finally, whatever the ITC you are eligible, because final input tax credit you know only after the end of the financial year. After taking the total common inputs and all, you will know the financial year. First, every month, whatever you are doing, you total. And then you look at the total of actuals as per the inputs, because you will get clarity after the end of the financial year, what is the actual input tax credit. So second situation, where aggregate of the amounts determined exceeds the aggregate of the amount which is finally calculated, then excess amount definitely will be claimed as the credit. But again, the month of September will be the final month for this one. Further important points, the ITC under GST can be availed and utilized only for the tax on output supply. As I told you, ITC will not be availed when the tax is not payable on the output supply. Only zero rated supply it will be available. On exempt supply, if you have ITC, you cannot claim it. Both the taxable and exempt supply is there. In this case, exclusively the inputs, input services and capital goods which are used for taxable supply, you can claim it. And for the others, for exclusively exempt, you cannot claim. For common input tax credit, the formula what we have seen will be taken into account. So what are the situations which require the apportionment? When they are used totally for the purpose of the business and partly for other purposes. Second one, when it is used for making the taxable supplies and zero rated supplies and for exempt supplies. In these two situations, apportionment is required. Let us take an example based on rule number 42. A registered person is in the business of manufacturing shoes. He gave 50 pairs of shoes to his friends free of cost. Oh, I'm sorry. This is just free of cost. Then what happens? In this particular situation, what is there? He gives free of cost shoes to his friends. So if he gives the cost free of cost, then free samples in this particular, if you see, though it is no GST will be applicable, the input tax credit is not allowed in case of free samples. Then registered person manufactures product tax at 18%, product by nil rate of tax, product tax export under pot. All three are manufactured. ITC attributable to exempt supply will not be available. For the others, it will be available. This is the way in which you are supposed to calculate the common credit, what we discussed in rule number 42. First, to take the total input tax credit on inputs and input services in the tax period, which is T. T1 is which are used for non-business purposes. T2 is which is used for exempt supplies. T3 is blocked credit 17 subsection 5. C1 is nothing but the ITC credited to the credit ledger, which is nothing but T minus T1 plus T2 plus T3. Then you also reduce T4, which is exclusively for taxable supply. You remove, you get the common ITC C2 for apportionment. Then this T1, T2, T3, T4 will be declared at summary level by the registered person. And ITC on input and input services for non-business segregated at invoice level. Once you get those details, the same will be added to T1 and T2 and T4. Whatever the portion which is there will be allowed as the input tax credit. Now, let us take an example here for Rule 42. Hawaii slippers are exempt. Take a case of Easy Footwear, manufacture of 2 varieties of Hawaii slippers and 5 varieties of other sandals and shoes. So here what is happening? Hawaii slippers are exempt, others are taxable. Okay. 2 varieties of Hawaii slippers are being manufactured, 5 varieties of other sandals and shoes are manufactured. Dyes are used in the manufacture of all the footwear. However, bright pink is used only for one of the Hawaii varieties. Black is used for sandals and shoes. Blue and yellow is based for all the varieties. Brown is also used for non-business purpose. So first what you have to do, track the inward supply. Input tax on brown dye. So here brown dye is used for what? Totally non-business purpose, 10,000. So non-business purpose is T1. Bright pink dye is used only for the Hawaii, purely for exempt. That is T2, 90,000. The amounts we are only assuming here. Input tax on black dye, which is 40,000. What is your black dye? For sandals and shoes, purely for taxable. That is your T4. Blue dye is used for all the varieties. That is your common one. Yellow dye, 15,000 is used again for all the varieties. That is. So what is T here? T will be total of all the input tax credit, which is 2,55,000. From this T, you have to reduce T1, T2, T4. T3 is not here in this example. So 10,000, 90,000, 40,000, 1.4 lakhs will be reduced and 1,15,000 will come. Common credit C2 is 1,50,000. How will this be apportioned? C2 will be here 1,15,000 into E by F. Into E by F is exempt supplies by total supplies. Fine. So that was what you have to do the turnover. So assuming turnover of Hawaii exempt is 3, others is 2. So 3 by 5. 3 by 5 into 1,15,000. 69,000 is your C2. D1. D1 is 69,000, which is input tax pertaining to exempt supply. T2 is very similar. It is 5% of C2. So C2 is 1,15,000. 5% of C2 is 5,750. So this eligible, how do you calculate the eligible credits? It is C2 minus D1 plus D2, which is C3. 40,250 is the eligible credit. So then the last step, you will reverse D1 plus D2 because these are pertaining to exempt and non. So first you claim the eligible credit, then you reverse the D1 plus D2. This is how you operate rule number 43. 42 rather. 43 is for capital goods, which we will discuss. Right? So therefore, to conclude how to do this, first to compute C3 separately. Okay. At the end, what do you do? First to compute C3 separately for ITC, for CGST, SGST, or IGST. D1 plus D2 for total financial year you take. Aggregate turnover for financial year, exempt turnover for financial year. If this D1 and D2 is more than the amount already added to the output tax liability, okay, in that particular situation, differential amount interest has to be paid. Whatever amount added to taxable liability is more than D1 plus D2, then you can claim back as a credit. So at the year end, you need to do a separate exercise with regard to this ITC comparison. So that was your rule number 42. Now, we'll just discuss rule number 43 also today. Don't get very confused because we'll again revise this and do some problems also. Then it will be very, very clear for you. Or because let me see if there is rule number 43 may become a bit complex here. So what we'll do is we'll just go through certain aspects of 17 subsection 1 and 17 subsection 2. I don't want to do rule number 43 now because it become very complex because 42 also was covered here. Let us just go through 17 subsection 1, 2 and 17 subsection 5. based on certain certain situations which may arise and how to take the call. And rule number 43, I would like to cover it in my next class, because then the mind will be more fresh and we can understand the further and then work out the problems based on that one. 17(1) and 2, as I told you, situations requiring apportionment. We just saw the rule also, partly for the purpose of the business and partly for other purposes. Goods and services are used, then it will be required. Taxable supplies and exempt supply, if it is used, then also it will require. Then what about the sales promotion schemes? Here what happened? There is a circular which came in 2019, which clarified the entitlement of ITC in the hands of the supplier in respect of various sales promotion schemes. Samples and free gifts was first taken. Samples which are provided free of cost without any consideration do not qualify as supply under GST, except where the activity falls under the ambit of Schedule 1. So that means without consideration, only in Schedule 1 if it falls, it comes, otherwise it is not supply at all. However, where the activity of distribution of gifts or free samples falls within the scope of supply on account of the provisions contained in Schedule 1, the supplier would be eligible to avail the ITC. Very, very clear. That means if free sample or distribution of gifts is normally done, no ITC, because it is not a supply. But if it is done as per Schedule 1, wherein without consideration between related person and distinct person, if you are giving free sample, on that GST has to be charged. You have to value the supply and accordingly charge the respective GST and paid. In that particular situation, ITC will be allowed. That is what the clarification is given. Further clarifications were given with regard to buy one, get one free offer as well. Buy one, get one free, if you observe, is not an individual supply of free goods. It is a case where two or more individual supplies and single price is being charged. At the most, it will be charged as if two goods are being supplied for the price of one. Here, ITC will definitely be available. In case of buy one, get one free offers, input tax credit will be available for the inputs, input services and capital goods used in relation to the supply of goods or services, or both as a part of such offers. What about discounts including buy more, save more? You buy more than 1,000 rupees. If you buy, you will get 30% discount. Such offers are being given. Then also ITC shall be definitely, the supplier shall be entitled to avail the ITC used in relation or both on such discounts. Buy more, save more also, no impact on availability of ITC. Buy more, save more, everything. It will be evaluated. Secondary discounts, you don't know these discounts are being given at the time of supply. After the supply is offered, such discount shall not be applied. Secondary discount means you never know. These discounts will come after the transaction is over on attaining the respective amount of turnover of gross receipts. In that situations, when value of supply also, you will not reduce this amount from the value of the supply. No impact of ITC. So these are the clarifications which are given with regard to certain items. Another important clarification which was given with regard to return of time expired medicines or drugs. What is the situation? In pharma sector, usually what happens is the drugs or medicines are sold by the manufacturer to the wholesaler and the wholesaler by the retailer on the invoice or bill of supply. One circular was issued which states that the retailer or wholesaler can return the time expired goods either by treating the same as a fresh supply or by issuing the credit. That means in case the manufacturer sends the medicines to the retailer, retailer has it with him, it got expired. He can either sell it back as a fresh supply or credit note also can be given to that extent by the supplier. In case the person returning the time expired goods is a registered person, he may at his option return the said goods by treating it as a fresh supply and also issues hereinafter referred to as return supply. That means if the person, whoever is retiring the goods, is a registered person, he can return it by saying that it is a fresh supply. That is what it says. The wholesaler or manufacturer who is the recipient shall be eligible to avail ITC of the said return subject to the conditions under 16. So therefore, this manufacturer is sending the products to the wholesaler. Wholesaler has it with him, after which some medicines they have expired. After they have expired, this wholesaler has sent the medicines back to the manufacturer. The moment he sends the medicines back to the manufacturer, he can raise the invoice based on that. The moment he raised the invoice, the ITC can be availed by the manufacturer. That is what he says. But in case the person returning the goods is a composition taxpayer, then he can return it by issuing a bill of supply. And if this wholesaler is a composition taxpayer, he will again have to pay the tax which is applicable, which is 1% or 2% as the case may be. 1% is the tax which is applicable. In that situation also, there will not be any input tax credit which is available. Fine. So that was your this one. Since we have some more time, let us just look at one problem here. But this is based on rule 43. So let's quickly go through 43, and if time permits work out. I wanted to cover 43 later, but we have quite some time left out. So let us just go through rule number 43 as well. Rule number 43 looks after the manner of determination of input tax credit in respect of capital goods and reversal in certain cases. That is what rule number 43 talks about. Therefore, subject to the provisions of section 16(3), the input tax credit in respect of capital goods, again, which attract the provisions of 17(1) and 2, partly used for business and others, or partly used for taxable and exempt supplies, shall be attributed in the following manner. Okay. First one, the amount of input tax which are used or intended to be used exclusively for non-business purposes shall be indicated in GSTR 2B and shall not be credited to the electronic credit ledger. So therefore, in this rule number 43, it says that it shall not be credited to the electronic credit ledger. That is what it says here. Okay, it shall not be credited to the electronic credit ledger. Whichever is used exclusively for non-business purposes will be indicated clearly and not be credited to the credit ledger. Second one, the amount of input tax used for effecting supplies other than exempt supplies will be indicated. That will get credited to the credit ledger. First, amount of input tax in case of capital goods not covered under A and B. That is, forget about the first case wherein for non-business purpose, and second one for taxable supplies. Other than these two, the next amount of input tax which is there, please take that as A, and useful life, let us take it as 5 years from the date of invoice of such goods. Where the capital goods covered under A subsequently comes under this clause. That means earlier the capital goods are used for the non-business purposes. Later it comes back to the common input tax goods. Then input tax will be denoted as A and shall be credited to the credit ledger. Subject to the condition that ineligible credit attributable to the period during which such capital goods were covered by clause A shall be calculated at the rate of 5 percentage points for every quarter. That means when clause A talks about capital goods used for exempt supplies, when it was covered under clause A, whatever credit which is used as ineligible credit will be calculated at 5% for this thing and shall be added to the output tax liability. This TIE shall be calculated separately for the input tax credit. Aggregate of amounts of A credited to the credit ledger under C common useful life is TC, which is your common input tax credit. Where any capital goods covered under clause B are subsequently covered under clause C, ITC also shall be availed to arrive at the aggregate value of TC. 60 months is the useful life which you have to take. So TC divided by 60 is the amount attributable on the common capital goods. Clarified always that useful life of any capital goods shall be considered as 5 years from the date of invoice, and the said formula shall be applicable during the useful life of the said capital goods. This is what you have to check. Then the amount of input tax credit at the beginning on all common capital goods useful life is TR, will be aggregate of TM for all such capital goods. So you just total the input tax credit. Once you arrive at the common input tax credit, then you have to calculate T, which is nothing but very similar to rule number 42. That is E by F into the total common credit. And the same explanation. If it is not there for the last period, then previous month will be taken into consideration. Then along with interest, TE shall be during every tax period shall be added to the output tax liability. Fine. Then some explanations are given both to Rule 42 and 43. How to calculate the aggregate value of exempt supplies. You shall exclude the value of services by way of accepting deposits, loans, advances, financial institutions, value of supply of services by way of transportation of goods by vessel from custom station of clearance in India to a place outside India, right? These value of supply of services will be excluded as per this one. And capital goods, what all shall incur? It is capital, plant and machinery. For determining the value of exempt supplies, how much you have to take as the value of land and building, the same as you go for the stamp duty. And the value of securities shall be taken as 1% of the sale value of securities. For value of exempt supplies, in case you are selling the land and building, in that case, the total land and building on the stamp duty value has to be taken into consideration. If you are selling any nature of securities, mutual funds, etc., value shall be taken at 1% of the security. So these are some rules with regard to valuation of exempt supplies. So what are the steps which you have to arrive at in rule number 43? Determine the common credit, that is the TC. Identify input tax credit on capital goods used for non-business purposes or making exempt supplies. Then identify, which is for making taxable supplies, the input tax credit. Whatever other than what is 1 and 2 is A. Initially covered, got subsequently covered under clause 3. We have to reduce the ITC at the rate of 5% and arrive at the total of A and get the total common credit. Once you do the common input tax credit, in case initially covered under 2, get subsequently under 3, you reduce ITC at 5% per quarter. Common input tax divided by 60 months, then you get the common input tax credit, which you apportion as per the exempt turnover by total turnover. Then add the TE to the output tax liability. Fine. So this is the way in which you have to do as per rule number 43. Don't worry about the terms because it may appear a bit complicated, the T2, T3, T4 or whatever. It is very, very simple. Once you do the problem, it will be able to understand. Only thing you have to remember, the way of apportionment is very, very important. That is a very, very critical thing. Now let us look at this question here. With the help of information given below in respect of a manufacturer for the month of September, compute the ITC credited to the electronic credit ledger for the month. Also compute the amount of ITC to be added to the output tax liability for the month of September, ignore interest if any. Outward supply of taxable goods exclusive of taxes 70,000. Outward supply of exempt goods is 40,000. Total turnover is 1,10,000. Inward supplies GST is paid on RCM. Capital goods used for taxable outward supply 2,000. Capital goods exclusively for exempt outward supply is 1,800. Capital goods for both taxable and exempt supply is 4,200. So subject to the information, assuming all the under conditions are satisfied, please calculate the amount of ITC which is to be credited to the credit ledger and amount of ITC to be added to the output tax liability. Try to answer this. Yeah. So here, if you see, capital goods exclusively used for outward supply is 2,000 rupees. First, you have to take that. Then capital goods exclusively used for exempt supply 1,800. In this case, it is since exclusively used for there is no ITC which is available. So therefore, 2,000 you have to take. Then capital goods used for both taxable and exempt supply is given as 4,200. So first you have to credit the ITC at 6,200 for the month of September. Common credit, as I told you have to divide by 60, useful life of 5 years, 60 months. 70 is the common credit for September. 70 into E by F, exempt turnover by total turnover. Exempt is 40,000 divided by 1,10,000, that is 25.45. The amount which you have to add to the output tax liability is 25.45. This is the way you have to work out the problem. As I told you, it is very simple. Only thing, if you read the rule, it appears very complicated, but when you actually implement the rule, it is kind of very, very simple, right? So with this section 18, I don't want to start now because it's again a pretty long section. It will take some time to read that. So in our next class, which is there on Thursday, we will cover the section 18. We will cover multiple problems based on rule number 42 and 43. And if you can just look at what all are there. Some rule number 40 is there, credit in special circumstances, transfer in case of merger, amalgamation, etc. Right? All these are there in your which shifting from composition scheme to regular scheme, how to do, and then some problems based on rule number 42 and 43. Rule number 44, with which talks about shifting from composition to regular again, change in constitution, transfer of ITC, and multiple problems based on what we are going to discuss. Then section 20, we come to manner of distribution of ISD, which speaks about the credit of what all has to be in ISD house, and some problems based on the ISD as well. So these are procedural aspects based on that, and also some multiple number of problems based on what we are discussing. We have been allotted 4 classes for input tax and job work provisions. But I will also try to take one session, because on the chapters what I covered, a supplementary study paper has been released. So any important amendments, we will touch upon them also if time permits in the coming classes. If time does not permit also, we'll take a separate class based on that to discuss the same. So therefore, my next class will be continuing on the 9th of this month, that is day after tomorrow on Thursday. So kindly revise all these things, only then you'll be able to solve the problems in a proper manner, because you have to be able to identify which rule to apply, how to calculate the common credit. These are all some critical things which you have to keep in mind. So please bear in mind that this is very, very important. This chapter as such is very, very important, though it may get a bit tricky. It is not very complicated. And please focus on the amendments, especially on the amendments on rule number 36.4 as well as section 16. Definitely fun questions may be asked in the exam based on these. So thank you very much for attending today's session. I will see you on Thursday at 6 p.m. to take further the topic of input tax credit. Thank you very much. Good night.